Street Week with Louis Rukeyser is made possible by the financial support of viewers like you. By the Travelers, insurance and related financial services working to provide financial peace of mind for over 40 million Americans. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential Beach Securities. Rock solid. Market wise. Produced Friday, November 9. Our panelists are Frank Cappiello, Monte Gordon, and William Gross. Tonight's special guest is Alan B. Bond, Portfolio Manager, W.R. Lazard & Company.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. In a famous chorus from the musical South Pacific, sailors stationed on a remote tropical island complained that they felt every kind of feeling but the feeling of relief. In the United States this week, on the other hand, relief was the predominant feeling. Relief that a particularly wretched political year had finally ended in an ill-attended, low-morale election that nonetheless managed to send an unmistakable message from California to Colorado to Michigan to New Jersey that the tax revolt was by no means as dead as Washington had assumed. And there was relief, too, at being able to turn back to the real world of the American economy. An economy that, in the truth-telling mood that somehow seems to appear only after elections, both the White House and the Federal Reserve were admitting was not so hot. Well, what do you know? Perversely, investors welcomed these admissions for two different reasons. First, because the Fed's more openly pessimistic outlook about the economic situation suggested that it would be easing short-term interest rates again soon. Second, because it was clear that once you boiled away the passing noise of food and energy prices, producer prices did not go up at all last month, which confirms that inflation is not likely to be the big economic problem in 1991, which in turn means that the Fed is likely to feel even more free to supply the cash that could head off the kind of U.S. financial collapse some gloomsters have lately been predicting. In short, the outlook seemed clearly to be for more green from Greenspan. And this, for better or worse, is one of the things for which the financial markets have been most fervently yearning. They also wouldn't mind a little more peace on earth, goodwill toward men, as the peacenik market showed again today when they staged a violent rally on a false report that Saddam Hussein had been the victim of a coup. The cooing of Wall Street's doves is not entirely pure at heart, of course. They'd settle for most any satisfactory resolution of the Persian Gulf crisis, and so the news of an intimidating American offensive buildup in Saudi Arabia spurred hopes that a settlement might be closer, one way or the other, and help send oil prices lower and bond prices higher. None of this was enough to start a convincing bullish revival on Wall Street, but it did at least enable investors to recover from a wicked sell-off the day after the election, when traders voted with their cash against a system that, despite all the signs of voter resentment, resulted in the re-election of 96% of the members of the House of Representatives, which happens to be a higher percentage than prevails these days in the Supreme Soviet. Welcome back, guys, I guess. No wonder, then, that investors were spelling relief. The election is over, and Congress has gone home. We tonight will look to our financial future in the company of a young guest who has already shown a remarkable ability to winkle out true value in a sluggish economy. Too bad we can't put him to work on the federal budget. But first, let's see what actually did happen in Wall Street in the week just passed. In an interesting turnabout, the 30 blue chips in the Dow Jones Industrial Average are now underperforming the overall market, which means that, for a happy change, the average stock is doing somewhat better than the headlines would suggest. For the week, the Dow lost just over 2 points to close at 2488.61. But every one of the broader indexes was up, even the oil-laden Amex, which hadn't had a winning week for more than 2 months. And looky here, our ELVS index has moved out of negative territory for the first time since July 27th, since which time the Dow has dutifully lost more than 400 points. Chief Ralph Acampora switched all the way from bearish to bullish on the next 6 months, and that brought the index to dead even. Precious metals continued their recent mild rebound, while the dollar continued its apparently endless descent, reaching another record low against the West German mark, largely on suspicions that we will indeed cut interest rates here and thereby give international hot money traders still less of an incentive to park their funds in greenbacks. Oh well, maybe we were just trying to give our German friends a sentimental present on the first anniversary of the Berlin Wall's collapse. And with all the talk about the 80s being over, let it be recorded that this week the 70s finally ended too. George McGovern and his business partners filed for bankruptcy. Monte Gordon, is the whole country going to have to file Chapter 11?
No, I doubt it very, very much. I never thought it did. I'm an incorrigible person in terms of my confidence in the resiliency of this economy, which is what I think is basically being demonstrated. What I think you're looking at, Lou, and you hinted at it, is the unraveling of the 80s, but more important than that, it's a kind of a downsizing of the U.S. economy to face a substantial competitive challenge in the 1990s, and I think we're going through the tail end of the convulsion necessary to bring us into a stronger economic position. And I think that's why we're in the kind of problem that appears to be a problem. I don't think it really is. I think it's part of the economy structuring itself for what will be a problem.
Are you suggesting then that once we get over the next few months, we will have a more streamlined, leaner, meaner American economy and more competitive?
I definitely think so. I think that what you're looking at in that regard is people, we're fighting for survivorship, and we're cutting down and ridding ourselves of those people that were unnecessary, those inefficiencies that built into the system. And I think that's what's coming out. It's a convulsion. It's going to take a little while in order to complete itself. And what it does create again is that kind of extraordinary investment opportunity for people who are confident in the process and wait for it to work its way out. I think it's going to take some time. Don't misunderstand me.
Do you think we'll be in recession for much of next year?
No, I think that the recessionary, what's happening now is we're seeing the surfacing of what were what you and I used to call years ago structural imbalances, which are now beginning to come up to the top. And I think that's going to go on until about the middle of 1991. By that particular point in time, I think much of it will have been wrung out, and we will look as though we have bottomed and we're beginning to come back up again.
Look out for your liquid assets.
Well, you never can tell, you know. Can't trust them at all.
Frank Cappiello, if Monte's right, and by the middle of 91 we're growing again, first of all, do you agree with that before I ask you the rest of the question?
That's pretty near my estimate that sometime in the late summer, early fall, we'll see a basing out of profits, and profits will start to climb up. And the stock market, if that's right, the stock market should start moving up in a new bull market sometime in January or February.
Yeah, well, that was my next question,
Yeah.
that if the market was going to, at mid-year, if the economy was going to be looking better at mid-year, the market would presumably be up before that.
Yes, 4 to 6 months is usually the lead indicator.
Now, they're not always right.
No, that's true. I mean, it's not a perfect indicator, but it's not bad either. But, you know, what we had this week is a better tone to the market, though. We had a couple of good technical factors, a lot of short covering. The shorts are getting very worried, and that was a good sign.
Why don't you explain what short covering is for those who don't think that this is a nudist?
Well, short covering is where you sell a stock that you don't own by borrowing stock from someone else, and you hope to buy that stock in at a lower level. He who sells what isn't his'n must pay up.
And the short covering means that these pessimists are beginning to worry a little bit that maybe they were wrong.
Yeah, and they're getting nervous about the market, and that's a plus. I think the second thing that's positive about the market is the OTC market. The high-tech stocks in the OTC market are beginning to perk up. They're doing a lot better, and I think your chart earlier indicated that the smaller stocks are beginning to run ahead of the blue chips, and that's positive.
If technology stocks are moving up, it doesn't suggest a Great Depression, does it?
No, I don't think we're going to have a Great Depression. I don't think we're going to have a Great Recession. I think we're going to have an ordinary average recession, and it probably will be very uneven geographically. And I think we may be setting up for a very good rally. We're not out of the bear market, but we're in for a very good rally short term, and I think the bear market should end by the beginning of next year.
We're more even geographically, so we have Bill Gross coming in from California, so let's hear his perspective.
Well, I disagree with the viewpoints on a bullish economy and a bullish market. I think we're in the midst of a liquidity crisis.
Why don't you explain what that means?
Well, this liquidity crisis, Lou, is a crisis brought about by banks being unwilling to lend money to the private sector. The Federal Reserve can put money into the system by increasing the money supply, but if banks are unwilling to lend it to corporations because they're afraid of bad loans and risky loans and write-offs, then the private economy will suffer. We saw some of that in the 1930s, and that created a depression. It's not as bad this time because of safety nets in the economy, but it's a situation that's very serious.
How can it be mended?
Well, the Federal Reserve is going to try and lower interest rates. That will help. That will bring some vigor back to the economy. But it can only be mended by an increasing willingness on the part of the public to buy goods, a general confidence in the system itself, and much of that has been eroded over a number of years. So I look for the economy to stagger, quite frankly, for the next 12 months, and for the stock market to do as well.
I know you take a close interest in the bond market. What do you expect to see there?
Well, I think the Federal Reserve has got to move quickly, and I think they will over the next several weeks. I think they will lower short-term interest rates, and that interest rates in general on high-quality bonds, not on low-quality bonds or junk bonds, but interest rates on high-quality Treasury bonds will drop precipitously. I look for long Treasuries, which are now at 8 5/8, to move down to 8% within a matter of weeks.
Within a matter of weeks, that's a pretty big drop.
I think it's a dramatic
Would you expect,
situation.
in view of your economic forecast, which is so dour, would you expect a further drop next year?
I think it's quite possible that if the economy remains in a recession, which I think it is, that we could see long-term Treasury rates close to 7% within 12 months.
All righty. In any event, panelists, it's time now to drive over to the full-service pumps and answer some questions from our viewers. Monty Gordon, Dale Murray of Crown Point, Indiana, says he often hears you pundits say of a company you admire that it has strong management. That's a catchy little phrase, says Mr. Murray, but he's not sure what it really means or how anyone can objectively identify a company that has strong management. What's your test?
Well, there are a number of ways of identifying it, Lou, in terms of specific measures. You can talk really about the financial performance of a company, return on investment, return on assets. You can talk about their ability to manage their assets against their liabilities. And you can talk about the overall action of the management in terms of innovativeness, its ability to attract good people. The key point that would be involved in here would be the performance and record of the company through different phases of the cycle. And companies that have identified themselves as having a strong management. You have companies like GE, you have companies like Walmart, you have companies like Disney, companies like Merck that have long proven that they are able to come up with good management. That's the best mark, the performance of the company.
Okay, Frank Cappiello, Jack Radow of Lake Oswego, Oregon, fears that one more stock market indicator has now bitten the dust. He's talking about the theory that when women's skirts get shorter, stock prices go higher. From personal observation, he reports, I notice that skirts are getting shorter and shorter. What has gone wrong?
Well, nothing's gone wrong. He's just impatient. It is true, over the last 70 years, skirt prices have sort of tracked the, or skirt hemlines have tracked the stock market. It's a good leading indicator. When hemlines go up, the stock market goes up. When they go down, stock market goes down. That happened in 25 and 26. And in 1929, they stopped going up and started to come down. In 1966, the Dow hit 1,000. That was the mini skirt, and it stopped going up, and the market went down. So I think we're on track now. Hemlines are going up. They're not quite at knee length. They're sort of at knee length, but they haven't gone above knee length. So I'd wait a while. I think we haven't heard the sell or haven't seen the sell signal. I think you'd sell when you see the whites of their thighs. No good, Luke?
We'll keep a close eye on that one.
Okay.
Bill Gross, Ilsa Perlman of Bayport, New York, says he's been wondering if there aren't some good investments in retirement homes, insurance companies, or other firms concerned with care of the elderly. No insult intended, she writes me, considering the fact that you are white-haired now. Nonsense, Ilsa. That's just a lustrous silver, you see. I'm putting a little in to make me look older and more distinguished. But I'm glad you think it's working. Bill, how about Ilsa's question?
I don't want to touch that one, Lou. I may not even try and touch that one up. There are three stocks, though, that I think might do quite well in that particular category. One is American Family Insurance. It's on the New York Stock Exchange. It is the largest underwriter of cancer insurance in the world. Secondly, National Medical Enterprises, a New York Stock Exchange company selling at about 11